you have received a contract, how would you determine whether it's a lease contract or it's a service contract? If you would like to know the answer, please follow this episode. In the first episode of IFRS 16, we are going to cover all these topics. First, we will talk about the introduction of IFRS 16, why it was required to implement, and what are the differences between old IS 17 versus IFRS 16. Then we are going to learn about what is the overall objective of IFRS 16 and the scope of the standard, where it applies and where it does not apply. Thereafter, we will learn the definition of lease, and I will simplify the definition which everyone can understand in a very simple format. And last but not the least, which is very important section of the entire episode, that how to determine if you receive any contract and you want to do your own assessment, or how to do the assessment whether it's a lease contract or it's a service contract, because the accounting implication will be totally different. So let's cover all these topics. Here you. Under IS 17, a lessee was required to classify lease into finance lease and operating lease based on a few classification criteria. A lessee was not required to report any assets and liabilities from operating leases on their balance sheet. They are instead referred in a footnote as off-balance sheet obligations. And due to this, there are many industries they used to design or draft lease agreements in such a way that there are no assets or liabilities recorded on the balance sheet. For example, you must have seen financials of aircraft companies before who never used to disclose any leased aircraft on their balance sheet. And operating leases were recorded directly as a lease expense as part of EBITDA. And if lease was classified as finance lease, then it was recorded as assets, and finance lease liability was recorded on the balance sheet. And in P&L, finance lease accounting will impact two line items such as depreciation on the assets and interest cost on unwinding of lease liability. And let's see what happened in IFRS 16. In IFRS 16, it changes this by requiring lessee to recognize all the leases on the balance sheet as right of use assets and lease liability. And undoubtedly, one of the biggest change to the lease accounting, the consequences of recognizing operating lease we will see a large difference in various financial metrics. IFRS 16 replaced IS 17. The main change in IFRS 16 is that it makes no distinction between operating lease and finance lease for lessee. And trust me, it's a paramount change. And the lessor accounting under IFRS 16 remains almost the same compared to accounting under IS 17. You might be thinking, what are the overall objectives of IFRS 16? The objectives of IFRS 16 is to specify principles for recognition, measurement, presentation, and disclosure of leases. Now the next question comes into our mind, that what is the scope of IFRS 16 and where it applies. Let me tell you, IFRS 16 applies to all the leases including subleases. However, please note that IFRS 16 does not apply to certain arrangements such as leases to explore for or use minerals, oil, natural gas and similar non-regenerative resources. And next one, we have leases of biological assets, which is covered under IS 41. Next is service concession arrangements, which is covered under the scope of IFRS 12. And next we have is licenses of intellectual properties under IFRS 15. And last but not the least, there are certain arrangements which covered as a rights under licensing arrangements, which is part of the scope of IS 38. However, there are two recognition exemptions given in the standard. Let's understand what it means and how that applies. It means lessee can decide not to apply IFRS 16 if the lease is for short term in nature or it is for low value item. Short term lease is any lease which has a lease term of 12 months or less. And please also remember that if lease contain a purchase option, then it is not a short term lease. The second recognition exemption is low value item. And lessee can choose low value item on lease by lease basis. This means there is no accounting of right of use assets or lease liability. And lessee will recognize all the lease payments in P&L on a straight line basis. What's low value leases of assets? Low value lease includes items like desktop, laptop, small office furnitures, telephone, or any other low value equipments. And ISB has something in their mind that any item $5,000 or below is a low value item. Lease is a contract that conveys the right to use of an assets. It's also called an underlying assets for a period of time in exchange of consideration. Let's understand lease in a simpler format. For any lease, there should be a contract first between lessee and lessor. And this contract should be for identified assets. You can also call specific assets, particular assets, or underlying assets. So in this contract, lessee is getting right to use that particular identified assets for a specific period of time, which is also called a lease term. So we can say this is a lease term. Okay? And this contract always have a consideration. Okay, so this identified assets where lessee is getting right to use of assets in exchange of the consideration. And consideration is not defined in IFRS 16. It's defined in other standard which you can refer in IFRS 3 and IFRS 15. So let's quickly understand how to do the assessment whether an arrangement contains a lease or not a lease. So there are three conditions given in the standard. Let's quickly go through them. The first one is we need to do the assessment. Is there any identified assets? It can be explicitly given in the contract or implicitly mentioned in the contract. And if we conclude that there is no identified assets, then it's not a lease. It may be a service lease contract which can be directly recorded in the P&L. If our answer is yes, that there is an identified assets, there is an underlying assets, there is a particular assets which given to lessee, then we need to assess on next condition here. Is the customer obtains substantially all the benefits from the assets? If your answer is no, then we will stop here. It's not a lease contract. But if your answer is yes, then the next condition we need to assess that who has the right to direct the use of the underlying assets. Is it customer, is it supplier, or neither of them? And what it mean by direct the use of the assets? That means how and for what purpose of the assets will be used by the lessee, and who is directing, who is the decision maker in this lease contract. Is it customer or supplier or None of them. So this assessment is very much required. And if you conclude that supplier is having right to direct the use of the underlying assets, then it's not a lease. And if customer has right to direct the use of assets, then it's a lease. We will understand in our next slide if neither of the party has control or the right to direct the use of assets. So let's have a detailed assessment in our next slide. Let's understand how to determine if a contract contains a lease or not. The first condition is that there should be an identified assets. It can be mentioned explicitly or implicitly in the contract. In the next episode, I will explain it more in detail about identified assets. If there is no identified assets, then it's not a lease. If there is an identified assets, the next question is to control the identified assets. Did customer has right to obtain substantially all of the economic benefits from the assets? Please note that customer can enjoy economic benefits from the assets either using it, right, or holding it, or subleasing the assets. It can be any form. If the answer is no, then it's not a lease and we'll stop here. And if the answer is yes, then we need to assess the next condition. The next question is who has the right to direct the use of assets? Is it customer or is it supplier or neither of them? In this assessment, entity should consider the decision making rights that are relevant to changing how and for what purpose the assets is used during the period of use. Please note that there will be some protective right for the supplier, right? And these should not prevent customer from having the right to direct the use of assets. So let's see if the customer has right to direct the use of assets, okay, then it's a lease. And we don't need to assess any more condition. However, if the supplier has right to direct the use, then contract does not contain a lease. And let's see if neither of the party has right to direct the use, then we need to explore the next question, the next condition, right? Is the customer having the right to operate the assets during the use of assets without the supplier having the right to change those operating instruction? If the answer is yes, then it's a lease, and if not, then we need to explore the last question for the assessment of lease. The last question is, did the customer design the assets or the specific aspect of the assets in such a way that determine the use of assets during the lease period? If the answer is yes, then it's a lease, and if not, then it's not a lease. Wow! Finally, we learn how to determine if the contract contains a lease or not. I'm sure you find it useful, and this is the overall assessment to determine whether any arrangement contain a lease or not